This video is a video on asset classes, okay, the different types of asset classes. So here, for different types of asset classes, the first one I'm going to start with are synthetic indices, the derivative synthetic indices. Synthetic indices are just algorithms which are made by the same market makers who made financial instruments, and they are of indices which are not really based their price on anything in real life of any real product, although Deriv does claim that they simulate real world markets of financial instruments. So the advantage with derivative synthetic indices are that you can trade them 24 hours, 7 days a week. Although you should know that the weekend days, the Saturday and Sunday candles, will be smaller usually than the weekday candles. So your trades for weekends will tend to have smaller take profits and will probably have less performance. So I advise you to only trade Monday to Friday, but if you do want to trade on the weekends, just make sure that in your backtest you will note down the weekend trades and see how they perform differently from those of the weekdays. And I gave you a PDF book for synthetic indices, so you can check that book and read it. I'm not going to go too much in detail in this video as I did on that book, so that this video won't be too long. So examples of the synthetic indices are these: the volatility indices, step indices, boom and crash. All these you see here, and some of them are newer markets which they released not too long ago. Now remember that you should only trade instruments which have trading data of at least 1 year or more, which you can backtest also for at least 20 trades with at least 1 year. That will now give you a good level of consistency when backtesting your backtests, and it will also have been able to sample different types of market environments. So for your synthetic indices, they also do have 3 open sessions when trading them intraday. Your first open session, the second open session, and the third open session. So your first open session will be 2 to 7 a.m. GMT. Synthetic indices use GMT time. Even for demarcation of beginning of day, they also use GMT time. And remember that GMT time is 2 hours behind Zimbabwe time and South Africa time, which Zimbabwe time and South Africa are CAT time, Central African time. And then in between the open sessions, sometimes there will be protractions. So protractions, remember, are just times in which the market usually moves against the direction of daily buyers. So on such a day where there would be bearish daily bias with the day closing to end with a red daily candle, you can see that there are certain regions in the protraction where price went up and it will be going up to go up above highs formed in the open session to take out stop losses of people who might have successfully sold in the first open session and who might have trailed down their stop losses to recent highs. Now, with synthetic indices for trading, especially volatility indices and the step index, remember you can use the first open session to predict your daily bias. So from beginning of the 2 a.m. GMT candle, if it moves further down more than it moves higher, you would have predicted a daily bias. And then opposite case scenario for bullish days, had it been in an uptrend, if the momentum of the whole open session would have moved further higher more than it moved lower, then it would have been prediction of bullish bias day. And then for the other things concerning synthetic indices, you can just check in the PDF which I gave you. And also remember that the other advantage with synthetic indices is that their trading costs are also smaller. Their trading expenses are also cheaper because Deriv will be trying to promote them for people to trade them. But remember that in trading, to some extent, there is nothing as a free lunch. So when brokers sometimes will be offering certain trading products with certain advantages, sometimes they may tend to be disadvantages which come with those trading products, and you might have to investigate to see which disadvantages they might have. So if I go to the properties, okay, you actually see that for V25 index, a volatility index, the margin cost, okay, for you to open a trade, okay, for every standard lot in US dollars will just be 55 cents when opening a trade for your initial margin. And then if your trade is to last for the next day or more, you will be charged a maintenance margin of just 55 cents of the US dollar. But if you compare now with financial instruments like this currency of Great British Pound versus US dollar, if we go to its property, you actually see that the trading costs are higher. The margin requirement will be $127 for each standard lot. Okay, and then also even the maintenance margin, if the trade will be to last into the next day or more, will be another $127. And then for the spreads, you will also even see, if we go to properties of synthetic indices, that the spreads also theoretically are also fixed spreads. So you will see that they will not be written as floating on the spread, although the spreads do change sometimes. But theoretically, they will not change probably as much as those of financial instruments. So that's another advantage. And also the spreads for synthetic indices will also be smaller. So the trading costs will also be cheaper. Then a disadvantage with synthetic indices is that with derivative synthetic indices, you can only trade them with derivative broker. So derivative broker, remember the regulation is weaker, tier 4 level regulation of BVI FSC, which is the British Virgin Islands Financial Service Commission. So there might be small manipulations in your trades, and the regulation will be more poor than which we can use when trading financial instruments with better brokers like FXView or access.com for us Zimbabweans. But for those outside of Zimbabwe, where you won't have sanctions, you can even trade with better brokers. And with FXView and XS, remember we have tier 2 level regulation of FSCA South Africa. So with derivative synthetic indices, you also might want to trade including sentiment in your trades, so that you try to compensate maybe for some manipulations which could occur, and also just in case if they might modify actually also just try maybe to trade money you can afford to lose in trading the synthetic indices, just in case maybe deriv might find someone else to make another algorithm for them. But for financial instruments, we won't have such a problems. The algorithms will definitely never change. But for synthetic indices, we are not sure if they could change in the future. So you can just trade maybe 10% of your total portfolio in synthetic indices. And also to trade with sentiment, just in case deriv might manipulate some of your trades. Meaning, for an example, if in your back test the instrument will be profitable on your strategy just when trading using the daily time frame trend. Now when you are trading, you will now look for trades when there is both the daily time frame trend and also the 4-hour time frame trend, which will now improve your performance. And remember, when opening your real accounts for deriv in your back office, to register them with under BVI FSC regulation, which is their best regulation, although it will still be tier 4 level and not really safe. And you will have to upload your proof of residency documents so that you can get that regulation. Now, derivative synthetic indices are not affected with fundamentals, world events. So you can trade them without considering any fundamentals, but maybe the only more of like fundamental you can consider is not to trade on USA public holidays in USA, because deriv will actually tell you that they change commissions of trades on their public holidays. So even a day before, like a day before Thanksgiving Day, they actually sent me an email. They usually send them a day before a USA public holiday, telling you that they shall, for financial instruments, maybe close some of the markets earlier, but then also they will also increase commissions of trades. So because they do not specify whether these changes will be for synthetic indices or just for financial instruments, it will be just safer for you not to trade synthetic indices on these days. But if you do want to trade, if you are impatient, maybe you might just trade binary options, since they show you your expected payout before you open your trade. That way you will now be able to see if you are okay with the payout that Deriv will be offering you. But it might be risky for you to trade CFDs now, because you don't know if Deriv will open the trade with a very big spread, which could hit your stop loss. And you really can't trust Deriv 100%, since the regulation is not so good, and also the it is booking trading, where you are having the broker as your counterparty. Although it's not everyone who has complaints with Deriv, you could actually trade and be profitable, but try to make sure that you withdraw your money once it almost reaches 10,000 US dollars. They might no longer want to partner with you once you make profits maybe over 10,000 US dollars, or if your account goes above that. There's actually someone on Reddit application on social media I heard who was actually getting a letter from Deriv that they would no longer want to do business with him once his account would reach 10,000 US dollars. Now, another asset class, okay, besides synthetic indices, are currencies, or the forex asset class. So these will now just be currencies of countries, and they will be traded in pairs. Okay, you won't be trading one currency on its own, unless if you are trading currency indices, but currency indices are not good for trading. Now, currency indices will now just be an index which just shows the average power of the currency compared to the currencies of the main uh, developed economies, developed countries of the world. So examples of your currency indices could be like the US dollar index, okay, which you can even see in Exness broker, or even on TradingView. There are many other brokers which offer it. And also, you should also know that one of the reasons why it's not safe to trade currency indices, unlike currency pairs, is that the currency indices have less volume or liquidity compared to currency pairs. And even though we don't trade the currency indices, you can use them as a barometer. So you can just use them to see the strength of the second currency on the currency pair that you will be trading, so that your trading will have more better performance and more longevity, more long-term consistency in your profitability. So for example, if you were to trade the GBP versus USD, which is just the Great British Pound versus US dollar, you will only now take sell trades of the GBP US dollar if on higher time frames, the daily time frame, the GBP US dollar will be in a downtrend. For me, I use period 9 and period 18 exponential moving average crossovers to determine trend, which try to follow institutional order flow. So when the Great British Pound US dollar will be in a downtrend using the exponential moving averages, you would only take sell trades for the Great British Pound US dollar currency pair only if it's in a downtrend, right, on the daily time frame. But then also you would only do that if now the US dollar index will now also be in an uptrend, so that you will have an opposing force between your US dollar and the Great Britain pound. So that will give your trade better performance and more long-term longevity, so that your trading will have long-term consistency of even a few years or more. Now, also remember that for foreign currencies, for Forex, I also told you that one of the fundamentals that you will consider was these are now financial instruments. They will be affected with fundamentals. So for Forex, another fundamental you will consider when trading inflation rates. And inflation rates, you can always find the information on the internet. It's public information. So when, for example, you want to sell the Great Britain pound versus US dollar, when the daily time frame is in a downtrend and the US dollar is in an uptrend, you also only take the sell trades if the Great Britain pound has a smaller interest rate than of the US dollar. So for example, if the Great Britain pound is an inflation rate of 4.0 and the US dollar is an inflation rate of 4.8, it will be okay for you to take sell trades of the GBP USD currency pair, which is just your Great Britain pound versus US dollar. But if the inflation rates change, sometimes they may change after about 6 months, 3 months, even a year or more. If they would change now for the Great British pound to now have an inflation rate of 4.9, and maybe the US dollar to reduce their inflation rates from their Federal Reserve Bank to now maybe just 4.7, you now no longer should take sell trades of the GBP USD currency pair. You would now wait for higher time frame trends to change for the GBP USD pair and the dollar index. Up until now, you will now be taking buy trades for the GBP USD currency pair. And then also remember that other fundamentals you consider when trading Forex are also to look out for red folder events, news events on forexfactory.com website, or on investing.com website. Also high impact news events which will have 3 bulls instead of 1 or 2 bulls. So when there's a high impact news event with the name of the currency written on it, you will not take a trade of any currency pair involving any one of the currency with the high impact news event soon before to even soon after the news event. But I already explained that in the video which I gave you for fundamentals. And also remember that there are other news events which affect all other asset classes besides just foreign currencies. So the other news events, the CPI, high impact news events, the Fed chair speech events, they are high impact events, and also the NFP news releases, which NFP news releases, high impact events occur on the Friday of the first week of each month, nearly all the times. Although there may be rare occasions when the NFP news event won't be on the week with the first Friday of the month. And remember that that whole week will still have less performance on trading compared to other weeks. So I personally don't trade financial instruments on that week. But if you do want to trade them, you only trade them from the Monday of that week to the Wednesday morning of that week in New York, USA time. So now when trading forex or currencies, remember that there are three groups of foreign currencies. So there's the major currency pairs, and then there's the minor currency pairs, and then also the exotic currency pairs. Now, the major currency pairs are the most traded currencies, which have a lot more liquidity and volume, meaning that there is more ease for you to open and close your trades, even if you are trading very large amounts of money. And they also have the advantage of cheaper trading costs. So usually the spreads and commissions charged by brokers to trade them will be cheaper. You have less expenses. Now, major currency pairs are currencies of the best economies of countries, of well-developed countries, which will be traded against the US dollar. So those are your Australian dollar versus US dollar, Euro versus USD, Great Britain pound versus USD, even the New Zealand dollar pair, the US dollar versus Swiss franc, even also against the Canadian dollar, and the US dollar against the Japanese yen. And then the most traded currencies of all forex currencies are the Euro versus USD and the Great Britain pound versus US dollar. So when backtesting, you can start by backtesting those ones, and they also have the most liquidity and volume and might respond better than other currency pairs to your strategies. Then now, the group of minor currency pairs are now currencies which are not traded against the US dollar, where it will be currencies of other countries traded against other countries. So minor currency pairs will now have less liquidity and volume than major currency pairs. and you should not trade minor currency pairs in times of depression, or when um, many countries in the world, especially the most developed nations, will be having very hard economic times. Institutions may not maybe want to trade them and put less money in the market, as there will be more fear in the market. And the trading cost of minor currency pairs could be higher than of major currency pairs. Then the third group for forex for currencies are exotic currency pairs. Now, exotic currency pairs will have the least liquidity and volume, meaning that you may find hardship when trading large amounts of money. For ease of buying and selling, opening and closing of your trades. And exotic currency pairs contain mostly currencies traded against the US dollar versus currencies of other countries of less developed nations. And then they may also have even some pairs which won't be traded against the US dollar, although they will usually be of countries of economies which are still developing, which won't be powerful economies. Now, the advantage of currencies, okay, considering all the three groups, are that the forex market, like I said, is the most liquidity or volume. It's the biggest market, which has a daily turnover of $7.5 trillion per day. And it also has the advantage that you have more ease of opening and sell or closing of your trades. But it does have the disadvantage that it might have more manipulation on the spreads, okay, compared to the stock market, where you have your stocks like Facebook, companies like even Apple, which offer shares. And the forex market is decentralized, so it has less regulation on the market itself compared to like the stock market, which has more regulation on the underlying market itself, not necessarily talking of the brokers. So now for the stock market asset class, these are just of uh, companies which offer shares which are offered to the public for you to buy, where if you are buying the actual underlying asset for when investing and not trading, you could just buy and hold the shares, expecting them to increase in value as you have profits. So stocks are just like companies like even Meta, or even like Tesla, or even companies like BMW. And then when we are now trading, we will now be trading maybe either CFDs or futures, which try to move with prices which are almost of the actual underlying asset of stocks which are bought by people, and the actual underlying of asset of the stocks will be bought from the stock exchange centers. So now when trading for or even buying and investing US stocks, they will be from, if they are of companies from USA, they will usually be from the US Stock Exchange Center, the New York Stock Exchange Center. Okay, and then if there are stocks of companies from UK, usually they will be from the London Stock Exchange Center for those who buy and hold them. So now, when we are now trading here, even though we trade through our brokers and not the stock exchange centers, now our trading instruments, the CFDs and futures, their market hours, their trading hours will now be open when also the stock exchange center, where the country from which the company comes from, will be during their day, usually maybe from around 9 a.m. to about 4 p.m. of the day of that country. But you can always check with your broker if you want to see the trading hours of the instrument, and they can always be listed on the properties of the instrument on your quote list. And you should also know that when trading stocks, the most liquid stocks which are safer to trade are stocks from USA. When backtesting, start by backtesting those ones. Actually, I would actually advise you to just trade only the US stocks, because you will see that the Hong Kong stocks, Europe stocks, or even stocks from Japan or Australia or even other countries, they have less liquidity and actually will be harder for you to trade. Now, the stocks also, remember, like I said, if you want even a confirmation with your broker for the trading hours, you can even check on the properties. And for most brokers, if you are trading through MetaTrader, they will now show you the trading hours in GMT time. For US stocks, the New York Stock Exchange Center will be open from 9 a.m. to 4 p.m. New York EST time. So now in November to March months, this is now what will now be 16:30 to 2300 GMT time. Remember that GMT time will be 5 hours ahead of New York, USA time in November to March months, whilst in March to November months, GMT time will be 4 hours ahead of New York, USA time when the time zones change. Then, since GMT time is 2 hours behind Zimbabwean time, Zimbabwe and SA time will now be 7 hours ahead of New York or USA time in November to March months. Then in March to November months, Zimbabwean or South African time, CAT time, will now be 6 hours ahead of New York, USA time. Now, when trading stocks, you will see that some brokers will only open the stocks for trading in the regular market hours, which are just the hours in which the stock exchange centers will be open. So remember, I said that for USA, that will now be 9:30 a.m. to 4:30, not to 4 p.m. USA time, which will be about 6.5 hours. And you should know that other brokers like Exness will open even for more hours of trading other than just the regular market hours. So other brokers like Exness or Capital.com will still offer trading for a few hours after the regular market hours and even for a few hours before the regular market hours. So trading before the regular market hours will be the pre-market session, and then trading after the regular market hours will be the post-market session. And you should note that trading in the pre-market or post-market session will have a slight disadvantage that liquidity will be lower and volume will be lower. So it won't be advised for people to trade very large amounts of money in the pre and post market sessions. And you can even see that for Exness, it has more 1 hour time frame candles than what XS broker had, because Exness also provides trading in pre and post market sessions. And it will be safer for you to trade just in the regular market hours, since at that time price will now no longer be just the algorithms moving, but it will now also be trying to track the prices of the actual underlying asset of the stocks from the stock exchange centers. And then another broker which can also offer pre and post market trading is Capital.com for Zimbabweans. But if you are outside of Zimbabwe, you can obviously get a lot more brokers, even those which can also offer you pre and post market trading. Then for stocks, you should know that stocks are also divided into three groups, where you have large cap stocks, mid cap stocks, and small cap stocks. And then there are even two extra groups of minor cap stocks and nano cap stocks. So large cap stocks will also be the stocks which have the most volume and liquidity, and which will be the safest to trade. Okay, in times where it there may be depressions or very hard economic times, even for the more developed countries, it will be advised for you to only trade the large cap stocks. These will be companies which will have a market cap, or let's say almost like net worth of about 10 billion US dollars to 200 billion US dollars, which should include maybe Tesla, Apple, and other companies. But you can always Google search the market cap sizes of the companies. It's public information. And then your mid cap stocks will have less volume and less liquidity. Okay, and those will be companies with market cap sizes or net worths of 2 billion US dollars to 10 billion US dollars, which will be available for shares. So these are companies which you probably will not trade in depressions or very hard economic times for many countries in the world, including the developed nations. Then the next group are your small cap stocks. These will be of companies with market cap sizes of 300 million to 2 billion US dollars. For this asset class of stocks, there also will be um, companies which you should not trade when there are very hard economic times for um, many countries, including even the developed countries. But a mistake I made for the mid cap stocks, you can trade them even when they you can actually even trade them when they are economic times which are a bit harsh in many countries, including the developed countries. But you just shouldn't trade them when there will be very hard economic times, like even during the depressions, because now there will be more fear in the markets and the institutions might not put a lot of money into trading them, so volume might be lower. But for the small cap stocks, you shouldn't even trade them even when the economy will be even a bit harsh, even when it's not yet very hard, but even when it's a bit hard, even in many countries and the developed nations, you should not trade the small cap stocks. There might be less volume. So same applies when trading currencies, when trading forex. If they are economic times which are a bit hard, okay, for many countries, including the most developed nations, don't trade the exotic currency pairs like for the next 4 years, like in 2026 to 2025 to 2028. And then for minor currency pairs, which is the second group for forex, also don't trade them when they will now be very hard economic times for developed nations and even other countries in the world. Not just economic times which are a bit hard, but even those which are very hard. But even in times when you have very hard economic conditions, you can still trade the major currency pairs in forex, which is the bigger group. And here now in stocks, in the stock asset class, you can still trade the large cap stocks even in very hard economic times. But remember now that for all financial instrument asset classes, be it stocks, forex, or even stock indices or bonds or other asset classes, don't trade when there are pandemics or when there is war, like a World War III or any war involving USA. When there are such geopolitical events, those may cause markets to have a lot of fear, and investors and large institutions might not want to trade, and that might cause less volume and liquidity in the markets when there are such disastrous events, like even in the uh, COVID pandemic. It wasn't a good time to trade, and your trading would have lower performance. Now, you shouldn't trade micro cap stocks and even what are called nano cap stocks and even also penny stocks which I think also fall in the micro cap stocks, which as they also have very low volume and liquidity, even though they are volatile and may cause sharp increases and decreases in prices, which can cause bigger profits or losses. But they are markets which may not be stable enough for you to have safer trading. Now, for those in Zimbabwe, when trading stocks, FXView broker has the problem of having high trading costs for day trading of stocks. So it would be probably better for you to trade stocks with XS broker. Even though XS is B booking, the trading won't be too bad since the regulation is still tier 2 level regulation of FSCA. And since it's a B booking broker, XS.com will have cheaper trading costs. Although obviously the broker will end up forwarding trades of traders who they see to be consistently profitable to forward them to the actual markets so that they won't be counterparty to such traders and lose money. So for FXView, it's just that right now it's on the weekend, it's Saturday, so the spread is very big. The difference between that green and red line on the 1 hour time frame. But when the markets are open for stocks from Monday to Friday, you will see that the spreads for FXView are bigger. So it might be better for you to trade stocks with xs.com if you are in Zimbabwe. And then for currencies, for Forex, since currencies have smaller commissions and spreads with FXView, you can trade your currencies with FXView. Your trading will be safer with FXView since it's an A booking broker. Your trades will be sent to the actual market. It's an ECN broker. The spreads and commissions from FXView broker for Forex for currencies, they aren't too much, although they will still be higher than trading with xs.com. So if you do want cheaper trading costs for Forex, you could trade them with xs.com, but just make sure that you always check your trades to see if XS won't manipulate your trades, although it probably will rarely do that since it has good regulation. But once you see that, they will now be forwarding your trades to the actual market by seeing changes in your spreads being bigger or your trades closing later than when your spread passes your take profit point. You can then maybe now maybe come to trade with FXView, since maybe the trading costs will probably be almost the same. But for safer trading, if you want safer trading for currencies, you can just start by trading them with FXView for Zimbabweans. But for those outside of Zimbabwe, you probably will have access to better brokers. So you can just check, and then if you're outside of Zimbabwe, try to see if you can actually get brokers with tier 1 level regulation, or like those regulated with FCA, okay, of UK. FCA, I think it's Financial Conduct Authority of UK, or those regulated with CFTC, Those are the two best regulating agencies. Then the third best could be ASIC from Australia. And then maybe the fourth best could be FINMA. It's at all those four regulating agencies are tier one level regulating agencies, which will be really strict on brokers to try and make sure that they do not mistreat their clients, you, the trader. Now, since the stock market has less volume than the forex market, for example, stocks from the New York Stock Exchange Trading Center, stocks from USA might have a daily turnover trading volume of about 20 billion US dollars a day, if I'm not mistaken. But you can just check in case I made a mistake. Whilst the forex or the currencies have a daily turnover trading volume of 7.5 trillion US dollars per day. So the stocks now, the shares like Tesla might have less volume, okay, that some people actually consider day trading stocks as gambling. But you can't just day trade them, but you just make sure that maybe you backtest them for at least 2 years on your backtest. Even though on other instruments we try to backtest for at least 1 year or more and at least 20 trades or more for a good level of consistency. For stocks, maybe if you want to day trade them, just compensate maybe by backtesting for at least 2 years. So you can get maybe a better level of consistency. And then for stocks, the other advantage now is that the stock exchange centers have better regulation than forex when trading currencies. The forex market, remember, is a decentralized market, so their regulation is weaker. It's a decentralized market because of the sovereignty of different countries. Now, for trading stocks, also you should know that stocks have gaps on their beginning of days, some of the days, not every time, but on some days. For many days, they will have a gap on beginning of each day. So I'm just going to zoom in. So when day trading or scalping stocks, you should make sure that you try to close your trades just before the end of the day for regular trading hours, which will be 4 p.m. New York time. Because when the next day opens now, like on that new candle, if you had been in a sell trade, price would jump up when the market opens if your trade would still have been open from the previous day, and you would now end up having a bigger loss. Sometimes, which now even ends up being bigger than your stop loss, and you would now end up risking more than what you were prepared to risk on that trade. But if you are trading with brokers which have extended trading hours of pre-market and post-market trading hours like Xness or Capital.com, if you want to keep your trading position open when the regular market hours end, maybe you can just reduce your positions and just close some of your trade positions. Then maybe just leave less trade positions if you are someone who trades large amounts of money. But if it's just small amounts of money, you probably won't notice any challenges, especially if you are trading with an ECN broker. But I think ECN brokers won't have extended trading hours. But if you have big brokers, or even those with good regulation, you probably won't have a challenge if you are still trading small amounts of money. And then now for the stocks, you should also know that because of these gaps which may form at beginning of each day, you also on the new day of each day should not trade within the first 5 minutes, maybe first 4 minutes of the day. For US stocks, that will be 9:30 to about 9:34 a.m. EST. At that time, there will be a rush of orders from large institutions since the market will be opening there. So there will be a lot of volatility that if you place a trade within those first 4 minutes, especially if you open it before the market opens, you may have big slippages where your trade may now be opened at a different price level than where you actually placed your order, because there will be big rushes of orders of very large amounts of money from the large institutions. So you can start to open your trades maybe from about 9:30, 9:34 onwards can be okay, but just try to avoid maybe opening them from 9:30 to 9:33. And then for stocks, the best times to trade them for scalp trades. Remember, scalp trades are trades which last even seconds to about 3 hours. Best times to trade stocks will be in the New York Open session, which is the second open session for financial instruments. So it would have usually been from half 8 a.m. to 11 a.m. New York time. But because stocks open an hour later from 9:30 a.m., you would now just be trading from 9:30 a.m. to 11 a.m. New York time. And then another good time to trade stocks is their afternoon session, which will now be half 1 p.m. to 4 p.m. New York EST time. You can also trade in the same direction of daily bias in that time, even also as well for the New York Open session. You can also trade in the same direction of daily bias, although the open session obviously will end up being weaker now from 10 a.m. to 11 a.m. New York time, but there will still be some volatility in the same direction of daily bias. Then if you are going to trade stocks on a broker with pre-market hours in the London Open session, which is the first open session of financial instruments, you should know that stocks and even stock indices don't respond well to trading in the London Open session. London Open session will be from 2 to 5 a.m. New York time. From 2 a.m. to 5 a.m. New York time. A 3-hour period. Now, when trading forex currencies, okay, like Euro USD, GBP USD, the major currency pairs, remember those which I said are currencies of the developed nations against the US dollar, including those which are in the main quote list, the GBP USD and Euro USD. Best times to trade them are in the New York Open session. They respond well there, which is 8:30 a.m. to 11 a.m. New York time. And then some of them might respond better in the London Open session of 2 a.m. to 5 a.m. New York time, although they will respond less compared to the New York Open session. And then you should not trade major currency pairs in the evening session of the Asian Open session or Asian Q zone, except for the New Zealand dollar pairs or the currency pairs traded against the Japanese yen or currency pairs traded against the Australian dollar. They can move well in the Asian Open session or the Asian Q zone. So remember that the Asian Open session is 7 p.m. to midnight New York time, whilst the Asian Q zone with a stronger movement will be from 8 p.m. to midnight New York time. It will now be a 4-hour period instead of the 5-hour period of the Asian Open session. So when trading major currency pairs, which can be traded in both the Asian session or the New York Open session, which are USD JPY, New Zealand dollar versus US dollar, and Australian dollar versus US dollar, you should know that they will respond better and give you better profits in the New York Open session, because the Asian sessions will have more of a consolidating profile. Okay, so for beginners, remember, consolidating market is just where price is more in a clustered market, so you won't have really bigger take profits, opposed to trending markets where price will move bigger distances, so you have bigger take profit targets and your profits will be more. So for those currencies which can be traded in the Asian session and the New York Open session, when you are recording your backtest, specify and label whether they are from which open session, because those in the Asian open sessions could be trades with smaller take profits and less reward to risk ratios. Then currency pairs which respond well in the London Open session, the first open session for financial instruments, which is 2 to 5 a.m. New York time, will be these currencies from the Europe region, the Euro versus US dollar and GBP versus USD. Trade well in both the London Open session and also the New York Open session with almost the same performance. And then for minor currency pairs, those which are traded not against the US dollar, you can trade these in the New York Open session, I think, but I'll check and confirm if they respond better in the New York Open session or Asian Open session. Then for exotic currency pairs, which are of developing economies, of least developed countries, and also against the US dollar, you can trade these in the, I think you can trade these in the Asian Open session. but I'll just check and confirm also. I'm not really sure. Then now, another asset class besides the stocks and currencies, but which are related to stocks, okay, are the stock indices. Stock indices are now just indices which track the average performance of a certain number of stocks, which usually will belong to a certain country, or sometimes which are stocks which belong to a certain industry, type of industry or business. So examples of stock indices are like these, where the US 500 is an index which shows the average performance of the top performing 500 stocks in USA, whilst the US 100 is an index showing the average performance of the top 100 stocks in USA of non-financial uh, sectors, and also which will be in the technology sector. And then the US 30, I think it's an index showing the average performance of the top 30 performing stocks or companies in the USA. But you can always check the definitions of all the other indices. It's all public knowledge. And then stock indices have an advantage compared to trading the actual stocks, because indices usually have more volume. The market has more volume, so you have more ease in buying and selling, or opening and closing of your trades, even with large amounts of money. And for stock indices, they respond well when doing scalp trades in the New York Open session. They do not respond well when trading in the London Open session or in the Asian session. But if you do want to trade there, if those are the only times that you are free because of your job, you can just try to trade them, but knowing that the performance will be less. But another good time to trade stock indices is also in the afternoon session, like when trading stocks. So you can also trade them in the afternoon session for stocks, which is 1:30 p.m. to 4 p.m. New York time, EST time. They also respond well there, even though the best time to trade them will be the New York Open session, which is 8:30 a.m. to 11 a.m. New York time. And then maybe if you are someone who is only available for trading the evening session, in the Asian session, maybe the ones which could respond better there maybe will be the Australia 200 and the JP 225 indices. But also now in the index asset class, you should also trade only instruments with a trading volume of not less than 20 million. So you can also just check on the internet for the trading volume, just like how you check for stocks. It's also the same thing when trading stocks, the actual shares of companies like Coca-Cola or even Meta. Don't trade stocks with an average trading volume of less than 20 million shares. Those will be low volume stocks. if they have less than such stocks will also have lower volume, and you might have problems in opening and closing your trade, especially when trading larger amounts of money. So some of the stock indices with low volume, I think, are like the Russell 2000, which you might want to avoid trading, although you can just check with the other ones. Then stock indices, they trade for about 23 hours a day. So they will have about an hour trading break. I think maybe around 11 p.m. to about midnight New York time, or it could be around 10 p.m. to 11 p.m. EST. You can just check, where there will be a pause in trading, and there could be a small gap when the market reopens. So maybe scalp trades, you could maybe try to close them before the that trading break, especially if price will be close to your stop loss for those doing intraday trading. But the gap won't be too big to affect short-term trades. Remember, your short-term trading is trades which last more than a day up to about a week. And for indices, for stock indices, they are safe for intraday trading, which is just trading within the day, which is day trading or scalping. Then also, forex, the currencies are also have enough liquidity for you to be able to do intraday safely trading. Then for stocks, equities, your companies like Airport, Tesla, they are not really good for day trading, intraday trading. So that is why I was saying you can now just try to compensate by your back testing, having back tests of at least 2 years instead of the back testing of where we usually expect a back test of at least 1 year or more. But the trading which is actually really safe for stocks will be short-term trading or higher time frames. So short-term trading, swing trading, or position trading. So remember, your short-term trading will be trading lasting more than a day to a few days, and then swing trading will be trades lasting more than a week to about 2 weeks or up to a month. Then position trading will be where you do trades lasting more than a month. Compared to all asset classes, the stock indices are probably the safest and also maybe better asset class for you to trade these days. And you can actually maybe start by backtesting stock indices. Although gradually, it is good for you to diversify your portfolio in trading. So even if you are someone who wants to trade only maybe three instruments, if you don't have a lot of free time, you can maybe just trade one, maybe stock index, maybe one currency with a major currency pair, and then also maybe one synthetic index from deriv. Because the advantage with deriv synthetic indices is that since they are not affected with world events or fundamentals, you can trade them even during a pandemic or a depression or a recession. Okay, and that will even give you an advantage because the financial instrument asset classes, which are the forex, the stocks, the stock indices, or commodities, metals, and cryptocurrencies, they will be affected with fundamentals in the event that there may be wars or anything which can affect financial markets and which may cause fear in the markets. And then if you do have more time, maybe you can add stocks, but maybe for stocks, only people who want to trade a lot of instruments can trade them since they have less volume and liquidity than forex and than stock indices. And then also for forex, for currencies, you should also know that when it comes to spreads, um, don't try not to have stop losses of less than 10 pips. Even also maybe when trading the indices, but especially for forex. Brokers can, when trading CFDs, which are here what we are trading on MetaTrader, unlike when trading futures, which have less manipulation on spreads or floating spreads. CFDs here, brokers can use floating spreads, which they can increase in size if price reaches near your stop loss with a small distance to make your trade make a loss earlier, or even to enlarge them if price is going in profit, and to make increase the spread a bit when price reaches your take profit point to delay your trade being closed in profit and reaching your TP target. So try to have stop losses of at least 10 pips or more in forex currencies, and then maybe in indices. For CFDs, maybe they can be slightly smaller, maybe at least an equivalent of 8 handles or more, which could be almost the equivalent of the 8 pips of forex. Then also maybe the same for stocks, since we also trade CFDs. Just try to make them at least about 8 um, handles or whatever is almost equivalent as the 8 pips in forex. So remember that when trading CFDs, your among different brokers, prices will be slightly different because the brokers are allowed to modify wicks of candles, the needles of candles, but their prices should have the same prices as of the bodies among all other brokers, so that they will be the same as from the central banks, maybe with just very minute differences for bodies, but they will be nearly the same. But they are allowed to have different sizes of wicks. So you might want to know that in case you may be taking trading signals from a signal provider using a different broker, you might need to compensate for that, maybe by trading with sentiment to trade in maybe a better market conditions. And then also futures now no longer have that disadvantage. When trading futures, futures will have the same prices even for weeks on all brokers. But futures now are traded in contracts, which expire after every 3 months. So there will be, in a year, there will be three contract futures which will be traded, each one within the different parts of every 3 months of a year. So when backtesting future versions of any asset class, make sure that you backtest at least for a year. So you have to look for a broker which will still have records of the previous three contracts besides the contract of the current 3 month period that you will be in. And then when you will now be moving from one contract period to another, usually the best time to switch to another one will be about 2 to 3 weeks before the beginning of the beginning before the official beginning of the month of the next quarter. So you will also then also move to the next contract when the open interest of the next contract will now be higher than the open interest of the current quarter's contract. So open interest is just public information which you can find on the internet, but you can use even barchart.com website. So open interest is more of just like the amount of volume of contracts being traded, I think worldwide. So even though we are maybe trading in the first quarter of January to March, when you are now in March, usually in the last 2 to 3 weeks of March, that is when the contract for April to June will now start to have a bigger open interest than of the first quarter of January to March. And you can even start trading the April to June contract even in the last 2 to 3 weeks of March. And for futures, they are actually probably even safer compared to stock indices on the CFD versions. The futures versions of the stock indices are even safer because futures are more of a gentleman's market, and the spreads usually I think will be fixed spreads and won't be floating spreads, and the prices will be the same across all brokers. So all these other asset classes may also have their futures versions. Okay, so I would only recommend you when trading to only trade maybe those three asset classes: the stock indices, especially that one, and also forex. And then if you are someone who really wants to trade a lot of things, you can then also include with stocks, equities. But the other asset classes that I won't recommend you to trade are metals, which have like gold or current or silver against currencies, and they have more manipulation, especially the gold. And then the metals are also affected with fundamentals more, depending on the supply or demand of the metals in the world markets. And then also commodities, be it futures or CFDs. I also won't recommend you to trade them since they are also affected more with fundamentals than the three asset classes I recommended you. And commodities are just actual products, agricultural products. And when trading commodities, you can just trade in the New York Open session. Even same applies for the metals. Just trade them in the New York Open session of 8:30 a.m. to 11 a.m. New York time. They probably respond better during for scalp trades during that time. And then another asset class I wouldn't recommend you is cryptocurrencies. Cryptocurrencies are just currencies which are based on digital assets which really don't have any real product in the world in which they are based on, and they are actually based on more of a Ponzi scheme because it's just a market which is based on people buying the cryptocurrency and putting money into it, although there is no real product. And the disadvantage of cryptocurrencies are that they have more manipulation, like gold also, which has more manipulation. And cryptocurrencies also have a disadvantage of being affected with fundamentals, also, just like commodities and the metals. They are affected to a greater extent compared to other asset classes, even though all financial instruments to some degree are affected with fundamentals. So cryptocurrencies, even though they are backed with no real physical product, they are affected with fundamentals in the sense that it's more of a Ponzi scheme where the actual underlying asset is where people buy the cryptocurrencies like Bitcoin, uh, where they buy and hold, hoping its value to increase in the future. So they will now be always hoping that the value will increase, and market makers now, for them to make money, will sometimes be uh, driving the price of the coins down, crashing the coins to make traders or the investors to lose money. So sometimes this can cause periodical changes in trend which are unexpected, where even though you are trading in a buy trade in an uptrend with your buy trades, the coins sometimes could crash and have downtrends. So that may cause um, some more of manipulation to a smaller degree where your trading's performance could be affected. So the cryptocurrencies can be traded against the US dollar most of the times, although sometimes they can be traded against other developed countries' currencies like the euro. And your sometimes you might even have brokers where you can trade the cryptocurrencies against other cryptocurrencies. So examples of your cryptocurrencies, those will be your Bitcoin. You might have even seen some of the symbols, the Doge coins, even the Litecoins, Ethereum, and even other coins. And when trading cryptocurrencies, also for scalp trades, best times to trade them will be in the New York Open session. But I don't recommend you to trade the metals, the cryptocurrencies, and the commodities. So also try to diversify your portfolio a bit, to which is just trading instruments from different asset classes, and also not just wanting to trade only one instrument, because diversification also gives you the advantage that if one asset class is affected with some fundamentals, you could still have profitable trades from trading instruments or from a different asset class. And it also helps to reduce losing streaks. Remember, losing streaks are just periods where you may have a lot of losing trades. They may also be reduced by you trading different instruments with even in the same asset class, but then also even now also trading different asset classes. Because the BRICS nations, for example, the currency they are trying to develop may affect the forex market to a very small extent. And then also for stocks could be affected with different fundamentals. Like for maybe if there is a stock market crash, okay, if there is a stock market crash where stocks just fall and drop sharply in their price, since market makers may do that maybe after maybe a few years, because people who buy and hold stocks for investing long term will be hoping that the value of the stocks will increase in time, and they will be increasing the values of their shares. So when stock market crashes, okay, there will be fear in the market, and the institutions might no longer want to really pour in money into stocks. So the stocks may be affected, and even the stock indices. So this is one of the reasons why you may also want to diversify your portfolio, and also to reduce your losing streaks. Your losing streaks will no longer really affect you now if you are trading different instruments within the same asset class and also different asset classes. But there's no need for you to trade many instruments if you are not able to trade them, if you won't have enough time, and if you can't also backtest all of them, or even read notes of all of them, which is basically this video, and maybe those are the smaller notes I gave you in the group. But I think I've already summarized everything in this video. If it's hard for you to uh, remember the trading sessions which are best for trading all of them, you can just trade those you are comfortable trading with. Then for forex, for foreign currencies, also note that you should not trade them in the afternoon session like we do for stocks and stock indices, because for currencies, they usually, on a bearish day where you take sell trades, they usually form their opposite end of day around 12 midday to 2 p.m., which is the New York lunch hour. So now the open session might have trades in the opposite direction of the bearish bias, which you might have had in the morning. So for currencies, don't trade them in the afternoon session, but you can trade your stocks or stock indices in the afternoon session for stocks, which will be 1:30 p.m. to 4 p.m. EST, New York time, for US stocks. Okay, whenever I was referring to times for scalping stocks, I was referring to US stocks. Things may now be different now when trading UK stocks or European stocks, or even stocks from other countries like Johannesburg, stocks from the Johannesburg Stock Exchange Center, or even stocks from Australia, from the Australian Stock Exchange Center, or even stocks from Japan, and even other stock exchange centers. Although if you want to trade those stocks, just backtest to see if they respond better using the same times that we use for US stocks, or to trade within their morning sessions or their afternoon sessions, of their regular trading hours. I think that may be even a better idea, because those are the times when the stock exchange centers of those countries will be open, which will be basically usually the daytime of those countries, when the stock exchange centers will maybe usually up around 9 to about 4 p.m. of that country's day, depending on their time zone. And then you should know that some of the stocks are from different stock exchange centers. They may have maybe breaks during their lunch hours. I think from the stock exchange centers which are smaller, maybe like the Hong Kong stock exchange centers, you can just check for the trading hours. It's public information on the internet. Yeah, so if you have any questions on asset classes and intermarket analysis, you can just ask me. And remember that on intermarket analysis, that is where I was just saying that um, when trading forex using intermarket analysis, okay, the currency pair, if it's in a downtrend on the daily time frame, only take the sell trades if the barometer or the currency index of the second currency on the currency pair will be in an opposing direction of higher time frame trend. So you have more longevity and more longer term consistency on your profitability. Then how you can use intermarket analysis for the other asset classes is that when trading other asset classes like stocks and metals and even commodities and the stock indices and cryptocurrencies, you also trade them when they are in the opposite direction on higher time frame trend as of the US dollar index. That dollar index, where I said you can check even on Exness broker or on TradingView. TradingView can allow you to see even other dollar indices, even from other brokers, even if you don't register accounts with the brokers. And you can just download the TradingView application or even to just go on their website. Usually on higher time frames, cryptocurrencies, especially those traded against the US dollar, stock indices, commodities, and stocks, actual shares, they usually move in opposite direction of the US dollar on higher time frame trends. And also even foreign currencies traded against the US dollar, and even those not traded against the US dollar, they also tend to move against the higher time frame direction of the US dollar index. So you can also use the dollar index for intermarket analysis in that sense when trading the other asset classes. But when trading foreign currencies where it's two currencies which don't involve the US dollar, you might not need to bother yourself by considering the US dollar in your intermarket analysis. You can just consider the currency index of the second currency on the currency pair, which is your quote currency and also your barometer. So only trade currencies where the second currency pair has a currency index, so that you can have that good opposing effect. And for the currency indices available You can always check them on TradingView, and maybe some other brokers might have them. Although most brokers which have currency indices will only have the US dollar index, but there are some brokers where you can actually find other currency indices which are not the US dollar index. So some of them could also be the currency index of the euro currency, or even for Great Britain currency and other countries, even including Japan. Yeah, so on TradingView, you could be able to see them there, especially if you download the application. So that is even the one from Japan, the one from Europe, the one from Britain. I think this one is from maybe either Switzerland. No, maybe the one from Switzerland will be this one, and then this one. You can always check them. Then this one may be from Australia, and that one from New Zealand, but you can always check them. Actually, yeah, if you select it, you can actually then see its name of the currency. And then when it comes to stocks, remember I told you in the video for fundamentals that you can check some of the fundamentals when trading stocks, equities on Finvi's website. So one of the fundamentals which is specific for stocks that I also told you in that video for fundamentals is earnings news reports. They only occur about 4 times in a year, once every quarter, when companies which have stocks or shares are just told to announce to publish some of their financial reports of earnings. You also want trade stocks and maybe also even stock indices on the days that the earnings occur, and the dates which they will occur will already be listed even in advance, and they are also public knowledge, so you can even find them even on other websites which offer news events which may not be this Finvi's website. So if you have any other questions on asset classes and intermarket analysis, you can just ask me.